Every week, two stocks hit new highs for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week, everyone is obsessed with the AI bubble. But what if the bubble isn't just in AI? The market is sending a strange signal this week. While tech grabs headlines, a stunning 23 out of 38 stocks hitting new 52-week highs are in the healthcare sector. This forces us to ask a critical question. Is this the great rotation out of AI into pharma, or is it evidence that the AI bubble is spreading beyond tech? To solve this mystery, we're investigating two healthcare companies that couldn't be more different. Medtronic, a $130 billion medical device giant that's supposed to be safe, and Insmed, a $42 billion biotech company that's burning cash at an incredible rate. By the end of this video, you'll have a clear picture of whether this healthcare rally is a smart move or a warning sign that the AI bubble is spreading beyond tech. First up is Medtronic. This is a $130 billion medical device titan. So why is it hitting 52-week highs? The simple answer is hype around what the CEO is calling an innovation supercycle. Medtronic is in the middle of a major corporate transformation. They're feeling the heat from activist investor Elliott Management. They're planning to spin off their entire diabetes business. And they're betting everything on a handful of new blockbuster products. Pulsed field ablation, a new technology for treating irregular heartbeats, the Hugo surgical robot, their answer to Intuitive Surgical's Da Vinci system, and the Simplicity renal denervation system, a procedure for tough-to-treat high blood pressure. And the market is absolutely buying the story. They just reported earnings where their cardiac ablation business, driven by that pulsed field ablation technology, grew a massive 71% year over year. Even more stunning, sales here in America are up over 300%. This was the concrete proof investors were waiting for. It confirmed the narrative that their innovation supercycle is real, and it's the single biggest reason the stock is powering to new highs right now. Now, let's open up the hood and look at the financial reality. The overall company posted 5.5% organic revenue growth, a number that's far smaller than that explosive growth we're hearing about from their individual breakthrough technologies. The cardiovascular division was a star, growing 9.3% and posting its strongest growth in over a decade. This was almost entirely driven by the explosive adoption of pulsed field ablation. But contrast that with their neuroscience division growing only 3.9% and their medical surgical portfolio growing even slower at 1.3%. These segments are now betting on next-generation medical robotics and AI to boost their sales. These bets on future growth come at a cost. The company is planning to increase R&D spending from 8% of revenue to 10% of revenue. They are also ramping up sales spending to advertise these complex systems to doctors, hospitals, and governments around the world, fighting for crucial insurance coverage and adoption. In fact, the company itself has noted that these investments are creating near-term margin pressure. For example, the huge sales of the new pulse field ablation system are weighted toward lower margin capital equipment. Here's the critical takeaway. This 5.5% overall growth isn't moving the needle enough to justify the hype on its own. To truly understand if these billion-dollar bets will pay off, you need deep insight into the clinical efficacy and the competitive landscape of each product. You'd almost need to be a scientist or a doctor to have that kind of insight. This immense complexity is a huge risk, and it's exactly why we have to question the premium valuation the market is giving them right now. This brings us to valuation. While many platforms quote an adjusted forward PE of 17, my own adjustment to remove theirs puts the true multiple closer to 23. Let's break that down. I model about 9% annual growth, factoring in 6% organic growth and a 3% shareholder yield. But if the forward PE contracts from 23 down to a more reasonable 17 over 5 years, that results in a total return far below the market average. In fact, for the stock to offer a market rate of return from today's price, it would need to drop 34% first. You're being asked to pay a premium for a future that depends on breakthroughs which are nearly impossible for a non-expert to assess. Given the immense execution risk and complexity, I view Medtronic as overvalued. This is a classic case where market enthusiasm has gotten ahead of financial reality. Finally, let's talk about what could derail this entire story. First and most glaringly is execution risk. The entire supercycle thesis hinges on flawless launches for the Hugo robot, simplicity, and continued pulsed field ablation dominance. Any delays in US approval for Hugo or any stumbles in these complex global rollouts would immediately call the narrative into question. Second, we cannot ignore the constant shadow of product recalls. This is not a theoretical risk. Medtronic just had a major FDA Class 1 recall, the most serious kind, affecting over 800,000 life-saving defibrillators. One more significant safety issue could shatter the innovation brand and evaporate investor confidence overnight. Finally, there's ferocious competition. They're not the only company in this space. Rivals like Johnson & Johnson and Boston Scientific are pushing their own competing technologies in ablation and robotics. Medtronic's ability to maintain its current growth premium is not guaranteed. Any one of these factors could be the pin that pops the bubble. So what has Medtronic taught us? It suggests that market optimism might be spreading past AI and forming bubbles in other complex technologies. Now, let's look at Insmed. What might a clinical stage biotech with no profits teach us about whether the market is justifiably rewarding innovation or getting carried away with speculation? Insmed is pure, unadulterated speculation. We're talking about a biotech company with a staggering $42 billion market cap that is simultaneously losing hundreds of millions of dollars every single quarter. Now, the story here is a two-part act. First, they have Arikayce, an established drug for severe lung infection that's on track to do $420 to $430 million in sales this year. It's a solid, growing revenue stream. But the real rocket fuel and the undeniable reason for this 52-week high is their new drug, Brinsupri. This is the first ever approved treatment for a serious lung disease called bronchiectasis. It's targeting a market of over 500,000 patients in the US alone who have had no prior therapy. And the market is pricing in a blockbuster success. The stock ripped to new highs after its US approval in August and a positive regulatory opinion in Europe in October. The early launch numbers seemed to confirm the hype, showing $28 million in sales in its first partial quarter. But here's the critical detail that the market seems to be overlooking. The company itself admitted that about 40% of that initial revenue was just inventory stocking at distributors. It wasn't all end patient demand. So the real test is whether patients actually are prescribed the drug. Now, let's look at the financial reality and let's be blunt. It's a bloodbath. In the last quarter, Insmed brought in $142 million in total revenue, but they spent $186 million on R&D and another $186 million on sales and marketing. Do the math. That adds up to a net loss of $370 million in just 3 months. Let that sink in. They are burning cash at an incredible rate, spending over $2.6 for every $1 they bring in. Now, the company will point to its robust $1.7 billion cash pile. But with this burn rate, that runway isn't as long as it seems. The math is clear. Without a dramatic and immediate explosion in sales, a massive value-diluting stock offering isn't just a risk, it's a financial inevitability. And this is what makes a bubble-like $42 billion valuation so worrying. Valuing this company is a paradox. There's no PE ratio because there are no profits. So the market values it on a multiple of future sales. a much more speculative metric. For a biotech company like this, forward sales multiples can range wildly from 8 to 30 times revenue. That's the difference between an $8 billion company and a $30 billion company right there. At a $42 billion valuation, the market is pricing in absolute perfection. The market is assuming Brinsupri achieves multi-billion-dollar peak sales and that the company can somehow rein in its terrifying cash burn. With such high costs to overcome, I believe the lower end of that multiple range is far more realistic. My current valuation, with weak confidence, is $8 billion. Now, to be fair, if they hit $2 billion in revenue and control expenses, they could maybe grow into this $42 billion valuation. But when I look at other biotechs with similar stories, like Crystal Biotech, which has far cleaner financials, Insmed just looks excessively expensive. For me, this isn't an investment. It's a massive gamble. And given the extreme execution risk and sheer complexity, it's a gamble I'm not willing to take. I'm staying far away. Now, let's talk about what could obliterate this story, because the risks here are massive. First and most obvious is commercial failure. The early Brinsupri launch numbers were inflated by inventory. The entire thesis now depends on the difficult art of persuading doctors to prescribe this new, expensive specialty drug. If real recurring patient demand doesn't materialize almost immediately, the entire premise collapses. Second, they are on a cash burn clock. With a quarterly burn rate in the hundreds of millions, their $1.7 billion cash pile has a finite lifespan. This forces them into a corner. They must either launch perfectly or face severe, value-crushing stock dilution. And finally, their pipeline is a distant hope. While they have other drugs in development, they are years and hundreds of millions of R&D dollars away from contributing. For this $42 billion valuation, there is no plan B. So what's the takeaway? Insmed is the perfect example of a story stock where the narrative has gotten way ahead of the facts. It embodies the kind of speculative frenzy we questioned at the start. Is the bubble spreading beyond AI? In my view, the combination of terrifying cash burn, a binary bet on one drug, and a valuation that demands perfection make this a clear no for me. It's a powerful lesson in how market optimism can sometimes just be a sugar high. Today, we looked at two companies hitting 52-week highs with one common thread: hope of blockbuster innovation. Medtronic showed us that even a steady, boring medical device titan can get swept up in a bubble narrative. Investors can create an innovation supercycle bubble valuation despite narrow growth and high complexity. Insmed, on the other hand, was a masterclass in pure speculation. A $42 billion valuation built on a promising drug launch, terrifying cash burn, and a future that's far from guaranteed. The big picture lesson? The market's momentum isn't confined to AI. We're seeing powerful and potentially risky rallies in complex sectors like healthcare, where exciting stories can sometimes overshadow financial realities. If this analysis was helpful, please hit the like button. And since you stuck around to the end, join me on Discord. I'd love to answer any questions you have. Thanks. Bye.